explain why value stocks seem to do better than growth stocks when there is a lot of inflation?
Okay, there's a lot of different variables to this, but one of the things as far as just think about what growth stocks are versus value stocks. A value stock usually was a growth stock at some point. They started a business, they grew it, they borrowed money to invest to grow that, and eventually they got to where they kind of slowed down and everything became kind of I don't want to say cruise control, but steady. And so they started still generating revenue and income, but instead of investing that in a company to grow it, they've hit their capacity, so they're paying that out in dividends. So on that flip side, that growth company could be that same value company that was 20 years ago. If they needed to borrow money to go out there and build that company or continue to grow it and get to that next level, then inflation setting in, the borrowing costs are a lot higher. So that's why what you saw last year, with since the pandemic and prior to that, since 2008 recession, we saw interest rates kind of the lowest we've seen in some time. So it's very cheap and easy for a company to go out there and borrow money. Then you tack on the private investment equity that's been thrown into the mix as well. Cash was cheap, so it's very easy to grow. But once cash started getting more and more expensive, that's where you saw kind of a hindrance on those growth companies. Whereas a value company had cash on hand, they're able to weather the storm. They're able to continue to reinvest in themselves because they generate their own money versus going out and borrowing it. That's one of the biggest reasons we see the inflationary pressure on growth companies.